friend of mine told me the other day that he only invests in money market accounts because money market accounts are perfectly safe. He can never lose his principal. He only increases his wealth through the interest. I suggested that he might take a look at gold and silver if he's interested in safety of purchasing power. And he said, gold and silver, they're too volatile. Then they've only been going down lately. I could lose everything by investing in those. So I thought I'd check out the safety of the money market account that he's investing in and compare it against my preferred investment. So this is the summary prospectus of the Fidelity Select money market account. And I went through it. I found some interesting things. So for example, if we go down to annual fund operating expenses, the total operating expenses are 0.3% per year. So this is the money that Fidelity is going to charge their customers for managing their funds every year. Go to principal investment strategies. So they invest in US dollar denominated money market securities of domestic and foreign issuers and repurchase agreements. So they're buying not only US bonds, but also foreign bonds and repurchase agreements. Whatever repurchase agreements are, I'm not sure what they are, but they don't sound too safe. And then potentially entering into reverse repurchase agreements. So I guess if they counter the repurchase agreements with reverse repurchase agreements, maybe that's a way that they're hedging their risk. I don't know. I'm not sure I really understand what these repurchase agreements are, but they don't sound too safe to me. Investing more than 25% of total assets in the financial services industries. Okay, so this is investing in banks and insurance companies, probably the same banks and insurance companies that required so many hundreds of billions of dollars worth of bailouts over the past few years. Principal investment risks. We have interest rate changes. So interest rate increases can cause the price of a money market security to decrease. Well, I thought the point of the money market account was so that it would keep everything in short duration maturities so that interest rates wouldn't affect the value of the money market account. Foreign exposure. Entities located in foreign countries can be affected by adverse political, regulatory, market, or economic developments in those countries. Well, if there's a lot of risk there, so much risk that Fidelity has to disclose it, why are they investing in foreign securities? Financial services exposure. Changes in government regulation and interest rates and economic downturns can have a significant, they had to put in the word significant there. Usually when companies put in subjective words like significant, there's a reason for that. Significant negative effects on issuers in the financial services sector, including the price of their securities or their ability to meet their payment obligations. Well, if the risk here is so significant, why are they putting more than 25% of the fund's assets into financial services securities? Okay, issuer-specific changes. A decline in the credit quality of an issuer or a provider of credit support or a maturity shortening structure for a security can cause the price of a money market security to decrease. Seems like there's a lot of things in here that can cause the money market account to decrease in value, and Fidelity has to disclose it. An investment in the fund is not a deposit of a bank and is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your initial investment of $1 per share, it is possible to lose money by investing in the fund. Boy, they keep saying that over and over and over again. You suppose it's possible to lose money by investing in this fund? Fidelity seems to think so. My friend doesn't. Okay, well, if there's risk, maybe there's return. Well, in 2003, 2004, the returns didn't look too exciting. They were about 1%. 2005 through 2008, modestly interesting. 3%, 4%, 5%. Then we get to more recent times. So from 2010 to 2012, the fund looks like it's averaged about 0.1%. So it's charging 0.3% to manage your money, but it's only giving you 0.1%. Seems like guaranteed downside to me, plus all those extra risks that could result in complete destruction of your principal. Alright, well, I've seen enough of this. Let's focus on my investment here. First off, it seems a lot easier to understand to me. It's a 2007 West Point Silver Eagle. It's been graded MS70 by NGC, so NGC feels that this is a near perfect coin according to their standards. And here's the 2007 date stamped by the U.S. Mint. So they're guaranteeing that it was made in 2007. And 2007 West Point coins that are MS70, I don't think they're going to be making any more of those. So the rarity is pretty good, much better than dollars held in a money market account, I think. Let's turn this over. I like actually feeling my wealth. It feels real good holding this coin. So you can see the West Point mint mark here. So you know that it's a West Point coin. And it says 1 ounce of fine silver. So as opposed to the money market account, where one share being $1 doesn't guarantee you that one share is going to be $1 in the future, I can guarantee you that this coin will always be 1 ounce of fine silver. And collectors are probably always going to seek this coin, and so in the future I should be able to sell it and obtain some cash, which I can then use to fund my short-term spending needs. So anyway, it seems to me that this right here is a much more solid bet than the money market fund. That's my opinion. I'm going to be holding on to that, and hopefully I'll be able to convince my friend that he should also be considering things like this.